US banks tap Fed's repo facility as overnight rates spike. A warning sign for global markets. When major US banks start borrowing directly from the Federal Reserve, the world pays attention. This week, several American banks tapped the Fed's Standing Repo Facility, SRF, a move that signals rising stress in short-term funding markets and hints at deeper liquidity concerns across the financial system. What exactly happened? On Wednesday, U.S. banks borrowed $6.5 billion through the Fed's repo facility, the largest single-day amount since the pandemic, excluding month-end or quarter-end periods when temporary funding spikes are common. At the same time, the overnight repo rate climbed sharply to 4.36% before easing to around 4.12% later in the session, levels well above normal. Such jumps outside typical month-end cycles suggest that something unusual is happening beneath the surface. A tightening of cash liquidity within the U.S. banking system. Understanding the repo facility. The repo, repurchase agreement market, is where banks and financial institutions borrow short-term cash, usually overnight, by selling government securities as collateral. The next day, they buy those securities back with a small interest payment. The Fed's Standing Repo Facility serves as a backstop, allowing banks to access cash directly from the central bank when market liquidity dries up. So, when banks turn to the Fed for funding, it often means they are struggling to find affordable short-term money in private markets. Why is this happening now? Analysts point to several reasons. The US Treasury has been issuing large amounts of short-term debt, draining liquidity from the system. On the same day, the Treasury faced $40 billion in payments, with another $23 billion due the following day, sucking cash from the banking system. As a result, reserves at commercial banks have fallen, leading to higher borrowing costs. In simple terms, too much government borrowing and not enough free cash in the system. A signal of financial strain. Economists say this is a sign that liquidity pressures are building in the U.S. financial system. If such trends continue, the Federal Reserve may face a dilemma. Either allow rates to rise and risk tightening credit further, or inject liquidity to stabilize the system. This could have broader consequences. Tighter U.S. funding conditions often lead to a stronger dollar, making it costlier for emerging economies to import goods or service dollar-denominated debt. Global investors might pull funds from riskier markets to park money in safer U.S. assets. Commodities like oil and gold could see short-term volatility as traders react to changing liquidity conditions. Global implications. When the world's largest economy faces liquidity stress, the ripple effects spread quickly. Emerging markets, including countries like Pakistan, India, and others heavily dependent on imports, may feel indirect pressure through currency weakness or increased borrowing costs. A persistent funding squeeze in the U.S. could also impact trade finance, as global banks become more cautious in extending credit for international transactions. The bigger picture. This development doesn't yet signal a full-blown crisis, but it serves as a warning light on the global dashboard. In 2008, similar liquidity pressures in the repo market were among the early indicators of the financial meltdown that followed months later. Today's situation is different, but the lesson remains the same. When cash becomes scarce, credit risk rises, and markets turn nervous. The fact that U.S. banks are now turning to the Federal Reserve's emergency funding window should not be ignored. It may simply be a short-term mismatch, or it could mark the beginning of a deeper liquidity strain in the world's most critical financial system. Either way, the global markets will be watching closely, because when America's funding engine coughs, the rest of the world catches a cold.